Hello everybody and welcome to the Confident Compounding with Corey Kramer YouTube channel. I'm recording on location here today, so this is a little bit of an experiment. I'm going to see how it works out. I had a request for Starbucks a while back, and it's been over a year since I took a look at it here on the channel, so that's what I'm going to do today. If you have a request you'd like me to take a look at, just put it down in the comments. I'll get the ticker on my chalkboard at home eventually, and eventually I will make a video either here on YouTube or on the free tier over on Patreon. So check out the free tier over there. I post all the videos I post here on YouTube plus more, especially if it's a smaller company, the request that probably not too many people are going to be interested in. I post those for free on Patreon. I also have weekly picks over on Patreon for $25 a month, so you can check that out while you're over there as well. All right, let's get into Starbucks. As always, this is not individual investing advice, just how I analyze stocks. All right, so let's go back to pre-COVID Starbucks here. This all looks really good. So we have great earnings growth. Earnings per share growth was 18% a year. And they had been growing that way for like over 20 years. So fantastic business. We always had jokes that there is a Starbucks on like every corner, you know, at some point, which is relevant to today. Not Starbucks where I'm at right now, but it is relevant because I think that probably the company's just gotten so big, there isn't a lot more growth left. But during this period, they did great. They had 1 year where earnings growth was negative during the great financial crisis in 2008, which is totally expected in terms of earnings. Now, the stock did fall a lot back here. It fell like 60%, if I remember correctly. 80%. It fell 80%. That's crazy. So if you get a good pullback in a stock, even though it's more mature, you could get good returns. So if we got an 80% decline, then that might be a potential opportunity to buy, even if we think there's not going to be growing at like 18% a year going forward. Now let's look at, but it's not really a cyclical business per se. It had a little bit of moderate cyclicality during the worst financial crisis that we've seen in a long time. Totally understandable. So now let's look at the earnings patterns today. We had a decline during COVID, again, completely understandable. They bounced back, more than bounced back from those levels. That's perfectly acceptable, perfectly reasonable. So we can just ignore this decline here because it wasn't really anything that they did. Obviously, it was just the pandemic and they bounced right back. So, but the issue now is they haven't been able to really grow since then. So we have a 9% decline. We had kind of that boom and then a little bit of bust. No big deal still. Our earnings are still above what they were in 2019. But then we have 20% growth, so it looks like things are on track. But now things are stagnating as of last year, and this year earnings are getting totally creamed. So when you go back and look, I don't know, since we can actually do it on the fast graph here. Let's go shorten it from 2019 to this year. And earnings growth is 0%, so no earnings growth. But if they bounce back after this year, they have a new CEO, maybe some of the stuff he does will work, and then we average that in, we have an earnings growth rate of 4%, okay, 4.5. So that's really slow. So basically what we're seeing is signs that they aren't able to grow as fast, and when there's a Starbucks pretty much everywhere, that's totally understandable. Now they try to have like Tivana like a decade ago to get another brand out there and grow, but they've just really struggled to do that. So with that in mind, the earnings growth rate that I'm going to be using, I think is generous. It's going to be just under 10%. So I'm going to assume that from 2025's earnings here, $2.42 a share, that after that they can grow earnings for the next 10 years at like 9 to 10% a year. Now, analysts are thinking 20% each of these years, but which could happen, but really they're just getting back to even. I don't think they'll be able to sustain that. We kind of see this kind of up and down pattern lately. I don't think they're going to push more than like 10% a year beyond that. I'm probably being generous, honestly. Now, obviously, if we have inflation, that they'll be able to pass some of that on, so they could have a faster earnings growth rate. But in terms of real earnings growth, I don't think they're going to be getting 20% a year growth going forward. Now, the stock trades at a 36 PE based on this low earnings number. So if they bounce back fast, but even let's see what price it's at. It's at almost $100. Let's find when they were $100 back here, like 97. So that was at a 28 PE. That was when earnings were expected to be about the same as they're expected to be in a couple of years. So even if we use the forward earnings, we'd be looking at like a 28 PE for 9 or 10% growth, in my mind. Now, the market might treat it like it's 20% growth, but I think just on the surface, the valuation looks really high, like kind of crazy high. But they have a good brand. They have a new CEO, who was successful, I think, at where do you go, Chipotle, like Taco Bell to Chipotle, if I remember correctly. I might be wrong on that. I don't ever place bets really on new CEOs when it comes to gigantic businesses like this. Now, sometimes it can work out, and I think they did a good job selecting somebody that at least has a chance. But the truth is, there's just Starbucks all over the place, so they're not going to be able to grow really fast, not fast enough to justify even a 28 PE. But we can look at the numbers and kind of see how that works out. So, and if we look at, this is a 3-year revenue number right here, cumulative. So over 3 years, they've only grown earnings 15%. And analysts think they've only grown revenues 15%, so like 5% a year. So when you consider that, and then you look at, I'm going to assume they can grow almost double that rate. Like I said, I think I'm being pretty generous. This is the earnings they're expected to earn this year, and so I'm expecting that to grow at 9.75%. And what I want to know is, after 10 years, what kind of earnings CAGR would I get? So if I collected all those earnings over 10 years, I don't think I made a debt adjustment. I did a little bit. You know what? I'm just going to go ahead and take that off. I probably looked it up a while back and haven't adjusted it. When it comes to like these restaurant franchises and stuff, there's always like, I guess it's pretty reasonable. The long-term debt to capital is what I was looking at, over 100%. So I was only using 20%. That's probably right. I'll put that back in there. I thought I was not giving them enough credit, but I'm certain that they do actually have that. So I make an adjustment to the stock price here for their debt. So the way that I normally do that is I look at the difference between the market cap and the total enterprise value, and I have about 21% difference in my spreadsheet, and that looks about what it is here. So I assume you're buying the company, you're buying the debt, at least the difference minus cash and everything, the difference in the market cap and total enterprise value. Okay, and then I want to know what kind of CAGR would I get if I paid for that based on their earnings and earnings growth. So because earnings are expected to be quite low this year, even though I'm assuming they'll grow at almost 10%, I want to know what kind of 10-year CAGR I would get from the earnings as an owner of a business. And that's only 3%. So that's a sell. To me, this is a pretty clear sell. Now, I could put some more generous assumptions in here. So one, I could just not care about the debt and just use a stock price like I was going to do a minute ago. So we can do that. That brings it up to 3.71% CAGR over 10 years based on the earnings and earnings growth. I could also change this earnings growth rate and maybe pull forward some of these future earnings growth the analysts think. So let's say things go fantastic and they earn $3.52 next year. We can put that in and see what that earnings CAGR would look like. What I say, 352. Okay, so that gets you up to 5.06%. That's more in line with the S&P 500. Probably what the market's pricing is that. Let me get rid of this real quick. Probably it's not quite at the market valuation, but in between 5% and 5.5% is about where the S&P 500 is right now, which isn't really a good valuation. once it gets below 5%, I'm usually selling in most cases. So based on valuation alone. So what I want to do is, okay, so analysts are looking for 22% growth in 2026 and 19 in 2027. So let's just call a 20% growth rate, which isn't going to happen long term. Again, I'm assuming that they can grow this for 10 years, like this rate each year for 10 years. If you do that, it gets you up to a 6% 10-year earnings CAGR. So this stock is, to me, extremely overvalued. If I owned it, I would sell it, and I would find something that has some real growth left. Yeah, it's hard for me to even, and then internationally is difficult right now with trade and geopolitics and all that. So yeah, it's hard for me to even find just like a positive ray of light here. Everything looks pretty bad. The stock price would need to get cut by 60%. My buy price, in case you're wondering, I do have one. But the recession buy price is like about $39.75 a share. If you just use these numbers, I think it's more like $30 a share. So it's just way, way overvalued. If it got super duper cheap, I might buy a little bit. Chances are it's just going to stagnate over time. That's what stocks like these usually do, because there'll be a lot of people that own the stock that bought it back here, and they're still doing okay. Like they're up 15%, 800% or something. In their mind, it's just they're not going to want to sell it and pay taxes. So it'll be this kind of slow decline or just going nowhere. Basically, we've had since earnings actually peaked in 2019, right? So we have a 3% return. That's close to where, probably a little less than inflation actually. So you haven't really gotten a return for like 6 years in this stock, unless you bought it on one of these dips, right? And then we're just trading it. But as terms of a longer term investment, doesn't look too attractive here. Okay, thanks for the request. If you have any other ones, put them down in the comments, and I'll see everybody later.